As I mentioned, this is an LBTT and ADS sort of Ask Us Anything session. You're invited to put questions into the Q&A box, and we'll be talking just hopefully about some interesting points in LBTT, the Scottish devolved land and building transaction tax that was introduced in 2015. The first question that's come in on our Q&A box, someone looking to know when you would treat a property in the course of construction as a dwelling for ADS purposes. So this question here is around the fact that when you look at the definition of dwellings and residential property for LBTT purposes, it says that it's not only a building which is constructed or used or suitable for use as a dwelling, but also a building in the course of construction or adaptation for such use. And this is important, particularly if you are buying, say, a partly built house or development, or indeed if you are buying something where, like an estate, there may be a main house and a couple of cottages or other bits of accommodation under construction. Generally, I think Revenue Scotland and HMRC have tried to be consistent with stamp duty, land tax, LBTT and VAT here, particularly the VAT concept of a golden brick. For VAT, it matters very much when you have a building, noticeably a building under the course of construction, as opposed to just a construction site. And the sort of bright line that has always been drawn for VAT purposes is what's called the golden brick. Now, this is the first brick on a traditional building that is above the level of the foundations. And sometimes for LBTT, it is referred to as the muddy brick, or at least sometimes amongst LBTT and stamp taxes nerds, it is referred to as the muddy brick, because the idea is that it doesn't actually have to be a brick above ground. Now, I mentioned VAT at the beginning of this answer simply because I think in the future, Revenue Scotland and also HMRC will seek to continue being consistent with the VAT position. Specifically because HMRC are currently looking at modern methods of construction. So not bricks and mortar, but maybe timber frames or houses built out of panels assembled off the site, to see when they think golden brick will apply in those more modern methods of construction. And it may be when you have, say, the first level of steel beams down for a steel frame, or when you have the first wall panel in. So there is likely to be additional stuff coming out of HMRC in the next few months on this, because they are actively looking at it at the moment. So there may be, further learning for LBTT and ADS that comes out of that. Someone has also asked, can you comment on whether a derelict property counts as a dwelling for ADS purposes? This is a slightly different point. The first thing to notice is that because of that condition, suitability for use, a building very easily transitions into the residential category or being a dwelling, because as soon as you start converting or adapting it for use or constructing it, it is a dwelling. But it only ceases to be a dwelling either when it is used for something that explicitly is carved out from being residential, or when it ceases to be suitable for use. And generally, the bar that the courts have applied here is a fairly high one, although not as high perhaps as the Revenue would like. The main case on this that came out a few years ago now is Bewley, which was a win by the taxpayer. And in Bewley, it was held that a property was not suitable for use as a dwelling because there were sort of high levels of asbestos that needed to be removed at significant cost. And this would involve sort of half demolishing the building. HMRC's arguments in Bewley were effectively, well, this is wind and watertight and you could plumb in and use sink, and no one said it had to be a nice dwelling. But the court's argument is no, capable of being used as a dwelling is not the same thing as being suitable. In any event, the bar here is quite high, and I would say there needs to be some form of major structural damage or safety hazard really applying to the property before you get into not being suitable for use. So a missing roof might qualify you, but a damaged roof probably doesn't. Things like a bathroom or a kitchen being removed, okay, technically you might not be a dwelling there, but HMRC will view that as not being significant enough to take you out of suitability for use. Same with Revenue Scotland. Another question that's come in through the Q&A, can you confirm that no ADS is payable on an inter-spousal transfer of property? The answer to that one is that it depends. What does it depend on? Well, unlike IHT and capital gains tax, there is no interspousal exemption or relief in LBTT. So you're really down to first principles here. Is there a land transaction? Yes, there is if you're transferring property from one spouse to another. And then you have to ask, is there chargeable consideration for that transaction? If it is a neat gift, then no, there would be no LBTT because there's no market value that we would impose on a transfer between two individuals. If there is debt secured over the property, then you will get into a situation where even if you are going to have a third-party mortgage at the end of it, so you're not actually assigning debt to the spouse who's taking ownership, the LBTT rules will deem some of that debt to effectively have been assigned and treat that as consideration. In a very sort of ordinary example, if there is £100,000 secured on the price, if there's £100,000 of debt secured on a property, husband owns 100% and transfers 50% to his wife, that would be treated as chargeable consideration of 50,000. The final thing is you have to go through the normal ADS analysis if there's chargeable consideration. Is it above 40,000? Does the wife work out as now owning an interest in two or more dwellings? Is she replacing a main residence? It would be perhaps slightly unusual if she was, but I can think of examples where she might be. And finally, and this is, I think, a rule that's often overlooked in the ADS, Revenue Scotland accept that where you have joint owners of property, that increasing your ownership share does not trigger the ADS. It's only if you like new quote unquote ownership that triggers the ADS. So if the spouse already owns, say, 10% and you bring them up to 50%, even if there is chargeable consideration, you're not necessarily within the ADS because you're increasing your share and not gaining a new share. So that's a good question with quite a bit to unpack on it. Scott, have we had any other questions coming through? Because those are the ones that have come up on my chat screen.
We do. So someone here has asked, I have a client resident on a houseboat purchasing a house. Is this counted as a dwelling for ADS, presumably meaning the houseboat?
That is a good question. I think the answer is probably, I would expect Revenue Scotland to maybe push against this. Now, I say this feeling like I might be hostage to anything in their guidance. I've certainly not seen anything on a houseboat, but you have to be disposing of a main residence. And I'm going to assume here that a main residence means a dwelling. And if Revenue Scotland were to take the line that our main residence has to be a dwelling, then you're probably not going to be able to treat the houseboat as a dwelling and therefore a replacement main residence, because a dwelling is by definition a building or part of a building, and I think the houseboat doesn't cross that bar. However, if Revenue Scotland don't insist that our main residence needs to be a dwelling in order for you to have a replacement main residence, then I think you've got a pretty good argument. I will look into that and follow that up by email, because there's a good little question in there, and that does the main residence you are replacing have to be a dwelling? I mean, certainly the one you're buying has to be a dwelling, but does the one you are replacing? Good question. Any more?
Some more here. Which okay. Right. A and B buy a property in a partnership which is operated by them.
Okay.
The property bought includes a dwelling house in which they intend to live, presumably as their main residence. They have disposed of or will in future dispose of their previous main residence, which was owned in common between them, but not held within the partnership. Does this scenario qualify for repayment of ADS?
That's a good question, and I think that it does qualify for repayment of ADS. The principle here is not really found in the ADS legislation. The thing that unlocks this is found in the partnerships legislation in Schedule 17 of the LBTT Act. And in there, we have special rules for some partnerships, but we also have general rules as well. And one of those general rules is that in an ordinary transaction, you treat any actions of the partnership as if it were an action of the partners, and the partners are, jointly and severally liable in respect of LBTT. And it goes on to say that this rule applies even if the partnership has separate legal personality. So if this partnership was a Scottish partnership in this question, or an LLP, this answer is equally valid. But your starting point is that for LBTT purposes, any normal partnership transaction, you treat as an action of the partners. So if they own via the partnership a dwelling house, this can be good and bad for ADS purposes. Certainly, I think the disposal by the partnership of that house would be treated as a disposal by them, and thus allow them to claim replacement main residence exemption if it was done in the 18 months before. And if it was done afterwards, there are some quirks in the recovery provisions. However, nothing in those would, in my view, block this from allowing them to recover, because you should just treat it as a disposal by them and kind of ignore the fact that it's in a partnership. I mentioned that there's sometimes a downside with properties being held in partnerships, and that is that sometimes a partnership can own, say, workers' accommodation on a farm, and you might have it as a mum and dad family farming partnership and include one or two of your children in there as they get older. Let's say son number one has 10% of that partnership. When son number one goes and buys their first home, I think those partnership rules mean that you treat them as owning the workers' accommodation in the partnership. and thus under the ADS rules being treated as owning 2 or more properties when they buy their first home, even though they are technically a first-time buyer. So that's something to be very wary of when you're acting in a situation where someone does have an interest in a partnership, because it might trip them into the ADS without the ability to claim the replacement main residence exemption. So got a couple more here.
Yeah.
One of them, I'm going to have to hold my hands up and say I don't have a great kind of canned answer. So I think this is a first principles answer, and it's to do with compulsory purchase of residential properties. Is the vesting of title following a compulsory purchase by way of general vesting declaration exempt from LBTT and also not subject to the ADS? So this is a good question, because I think the answer really is a first principles answer, and it's been a little while, I have to hold my hands up and say, since I have done any compulsory purchase work or advice. But my understanding is when something like a GVD is exercised, there is an obligation to pay commission or compensation to the party from whom you are obtaining the land. So if you think about, for LBTT purposes, you need to have a land transaction that is not an exempt transaction for which there is chargeable consideration in order for the transaction to be subject to tax, and that's LBTT and ADS. Now, some people would argue that with a GVD, because there is no conveyance, in other words, because there is no kind of instrument like a deed that passes between the parties transferring title, that perhaps there's no land transaction there. I think that's incorrect. The LBTT legislation around sections 5, 6, and 7 sets out exactly what you need for a land transaction. And basically, it is a buyer and a seller, and some form of reduction in one person's real rights or personal rights against some property, and an increase in another person's rights or personal rights. So you've got a land transaction where there's a GVD, even though it doesn't look like a normal conveyance. I think it's arguable that you have consideration, because if the statutory compensation you are required to pay is deemed to be consideration, then it's chargeable consideration. And by analogy, the fact that you have to pay it in exchange to get the thing is what brings it into the ambit of the LBTT, and that's why VAT is always something you have LBTT on. And is there an exemption? In this case, that boils down to, is there a relief? Now, there is a limited compulsory purchase relief for local authorities. However, those only apply where the compulsory purchase order is being exercised effectively on behalf of a third-party developer. So the local authority will acquire the property under the CPO and the GVD, and then flip it on to a developer for that developer to build out. So I think you probably are in a difficult position trying to argue, if you were looking to, that there would be an exemption from LBTT just because you are exercising compulsory purchase and GVD. And I think the fact that there is a relief targeting a limited class of compulsory purchases suggests to me very strongly that the revenue would not accept that just a normal compulsory purchase would be outside of the scope of the tax. Okay, we've got a couple of additional ones. Do you want to pick some of these, Scott?
Yeah. This one is a good question and a notoriously difficult point. So apologies, Bob, in advance before I'm break this one down and set it out, but this person has explained that they recently purchased a house 3 ways along with their partner and their mother, and they paid ADS on the purchase because and I think that's this person and their partner had not yet sold their previous main residence that they had been living in. But they did sell that previous main residence shortly afterwards and assumed that they would be entitled to reclaim the ADS that they had paid on their new purchase. But they were told, and it's not clear whether they were told by Revenue Scotland or perhaps by an advisor, that they were unable to reclaim the ADS because the parties who had paid the ADS, which was all 3, individual, partner and mother, were not the same as the parties who had sold the previous main residence, which was only this person and their partner. To make it slightly more complicated, this person has explained that their mother had also replaced her previous main residence, and presumably within the timeframes this had happened prior to the new purchase, but we'll assume that was within the relevant period. And slightly exasperated question, do we really not qualify for repayment in these circumstances when we have all replaced a main residence?
That is a great question, and it's a really difficult one. And the best answer I can give is a disappointing and slightly counterintuitive one. And that is, I think, certainly under the legislation as drafted, the legislation is not on your side, and I'm not convinced that the courts necessarily are, because the first tier tribunal has given a ruling in a similar case, which you may or may not be aware of, which is the case of Crawford. And the facts in Crawford are a bit starker than the one in your example, and the decision still surprises me when I look at it. And I know a lot of people who think that Crawford was wrongly decided. The facts in Crawford were a Dr. Crawford and a Miss Scott were buying a first home together, both of whom had lived separately. One of them sold their main residence beforehand, so was replacing a main residence. The other sold their main residence after the fact. So 2 separate main residences being sold. And the courts denied them the ability to recover ADS because they held that the way the recovery provisions were framed meant that each buyer effectively had to have been selling. It had to be the same replacement main residence for each buyer effectively, rather than having one replacement main residence beforehand and a separate one after the fact. Now, I feel this is probably quite an unfair decision, because I think that issue does not apply if everyone sells beforehand. The other point is that it's not clear from your question whether mum is moving in with you, but I think mum's interest in the new house would have to be the house that was the main residence. So she'd have to be moving in with you in order for the exemption to apply. So if that hasn't happened, then I think that's another reason. But unfortunately, what the ADS legislation says boils down to, if one buyer is caught, then all buyers are caught. So even if you and your husband are entitled technically to a recovery, unless your mum is as well, none of you are. And I think, unfortunately, given the way Crawford was decided, Revenue Scotland would just lean back on that. And your only prospect is probably pushing the issue to to a tribunal appeal. I know that sounds slightly pessimistic. All I would say there is that the first tier tribunal isn't binding. It's an arbiter of
Oh,
facts, but its decisions aren't binding on other courts.
just to stir the pot slightly, thank you to this person who just confirmed that mother will be moving in to the new main residence, which makes it even more tantalizing. But
Okay. And unfortunately, I think I see you've given your name as anonymous. If you want to drop us an email, I'd be happy to follow this up a little further with you. But unfortunately, I think the facts in Crawford mean that you're probably not going to be able to recover the ADS. So sorry, don't like to be the bearer of bad news. Um, I see quite a few more questions. I'll just pick one
yeah,
at random while you have a read through some of the longer ones, Scott. Um, Someone has asked, does subsale relief still apply in Scotland? And if so, what constitutes an expectation of significant development? So that is a good question. The answer is yes, in part. Subsale relief still applies in Scotland, but Scottish subsale relief is very much more restricted to the current SDLT subsale relief, also called pre-completion transaction relief, and the old SDLT subsale relief that used to apply. Under old style subsale, you can have long chains of parties, A to B to C to D, entering into subsales. And every single subseller in that chain. So if you've got A selling to B, B is a subseller selling to C, C is a subseller selling to D, and D is a subseller selling to E, and E is the end purchaser, then potentially B, C, and D can all claim the relief. And that's still true in SDLT. But for LBTT, it's only that first link in the chain really that can qualify for the relief. Now, it is not exactly how it's expressed in the legislation. They say that first contract cannot be an assignation or subsale. However, in practice, that generally means that you have to be buying it from the person who owns it. Doesn't always mean that. And you need to be the first buyer in the chain in order to claim the relief. The second big difference is that it only really applies to what we call, or what you might call, a freestanding transfer in SDLT speak. Those are sort of back-to-back conveyances. SDLT also allows transactions like assignations to potentially qualify as subsales, which LBTT doesn't. The third relief, and this is alluded to in the question, is that subsale relief is only available when there is an expectation of significant development within 5 years of the subsale. And there's a few points to make around that. Number one, the legislation seems a little confused on that point. They say that the 5 years has to run from the date of the subsale. Technically, that is the date that the B2C sale contract is entered into. I think Revenue Scotland and everyone else kind of accepts and expects that no, you calculate the 5 days from the date of completion of the subsales. Secondly, significant development has to be carried out commercially and for a profit. So if you are building, say, something for yourself to live in as the end buyer C, that doesn't qualify for the relief because you're not doing it on a commercial basis. Thirdly, significant development has to be on the facts involving the construction of new buildings or civil engineering works or works that are kind of equivalent to that. So you might say if you're knocking a building down to just a facade and then constructing a new building kind of behind it using that existing facade, that would qualify. But if you are stripping out an office in an old townhouse to convert it back into flats, that isn't going to qualify. The other thing about significant development is that there are a number of carve-outs from it. These are things like constructing agricultural buildings is not significant development because one assumes you can just sort of throw up a big corrugated iron shed relatively easy. The one that always stands out to me is that installation of wind turbines is not considered to be significant development, which I always find odd, particularly when we have a green cast to our government agenda, but also because it's just wind turbines that are precluded. So presumably hydro scheme installations are okay. And so it's not clear to me the rationale of excluding one form of renewables, but not others. Anyway, I hope that sort of gives a flavor of an answer to the question about stub-sale relief and significant development. It's always something I would add if you have a sub-sale, unless you do a lot of them, it's worth getting advice on because the rules are relatively strict. Scott, did you pick up anything from the Q&A box?
Good one here that probably touches on a couple of the more common things that lots of us will see day to day. So there are two questions in this. And the question is, so there's been a purchase of 4 properties and the same buyer and seller, and they've all completed within a 1-year period. But they've all been documented separately, so separate missives, separate contracts for each of the 4 purchases. The transactions are going to be treated as linked transactions. So the first question, I suppose, is how do you determine if transactions are linked transactions, particularly where you have separate contracts? And the follow-on question is, in the context of this deal, is the client, so is the purchaser eligible to claim multiple dwellings relief across the entire deal, so in relation to all 4 transactions? And pointed out here as well that all of the transactions are going to be subject to ADS.
Okay, so first of all, linked transactions. I think what we'll do is we'll talk about what makes a linked transaction. Then we will talk about MDR and linked transactions. It is perfectly possible that these 4 properties are linked transactions, and there are really 2 elements to the statutory test for whether 2 transactions are linked. Element number 1 is the sort of fiddly legal test, and that is that you have the same buyer and seller, or that parties connected to them, and then there is a specific tax definition of what connected parties means. That's usually quite an easy test to establish. The second part is the factual kind of test, and that is, were these transactions part of the same scheme, series, or arrangement? And that is whether or not those things are legally binding. So this is intentionally a very, very broad bit of drafting, and it's what a former colleague of mine referred to as a sort of scratch and sniff test. If you sit back and look at the facts and you think these probably are linked, they probably are linked. HMRC, a number of years ago, a guy there put out a helpful paper called Stamp Duty Chocolate Tax, using a kind of hypothetical confectioner's shop and a number of transactions in that shop to illustrate what he thought the linked transaction was and what it wasn't. And the kind of examples they give, and certainly the things I have successfully argued as linked transactions in the past, can be quite broad. So he gives the example that if there's a 2-for-1 offer and you buy two, then that is two linked transactions. If you come in and you buy a Twix and then half an hour later you come in and you ask to buy another Twix and you say, well, can you give me 25% off as a repeat customer? That, according to the stamp duty chocolate tax paper, can make those two purchases linked transactions because entering into the first one has affected the pricing of the second one. So it's not even as close as they have to be, say, conditional on each other. A good example from my own experience is an exchange of letters setting out a pipeline methodology for a property kind of sourcing agent to find and sell housing to a fund looking to invest in certain kinds of housing. And that letter didn't reflect any specific properties. It just set out the basis on which the agent would source properties and arrange their sale to the end buyer. These were all done by way of subsales, so original owner to agent to end buyer. And we were able to argue that the existence of those sets of terms meant that some 60 odd transactions were all linked transactions, which was incredibly useful to us in that context. So linked transactions is quite a low bar to get over. The best example where you could have identical buyers and sellers is really where you have four totally independent transactions. If you had a property that was being sold as lots and the same seller put in four independent bids on four separate lots and just won them all, then those could, in theory, be separate transactions, but if they are negotiated together, they can still be linked. It should be clear from all that just having separate missives does not make transactions linked or unlinked. What really matters is the circumstances in which they are negotiated, and are they all, quote unquote, part of one deal? That's really the way to think about it. If you've got four linked transactions over the course of a year or 2 years, then, well, let's stick with a year for a reason I'll get into, then yes, you can claim multiple dwellings relief. It is available where multiple dwellings are purchased as part of one or multiple linked transactions. The point I do want to make about 1 year is you may not know you have a lot of linked transactions queued up. And if the gap between 1 and 2 is more than a year, you might lose the ability to claim MDR. This is because normally what you would do is after you have purchased the first one, you would record it as a non-linked transaction. There's no other transactions that it's linked to. And when you complete the second transaction, you might go back and claim MDR by amending your tax return for transaction 1. However, you only have a year to make that amendment. And the alternative procedure you can use to try and recover overpaid tax after 1 year is called overpayment relief, and that specifically precludes making a claim for a relief. So really, you only have 1 year in which to start filing MDR claims for earlier purchases. I know some people have said that you can claim MDR within 4 years. I think that's just wrong.
Okay. Thank you to everyone who has responded to our responses as well.
That's very kind. I think we'll just pick one more And
Here's
then let's end on a nice nerdy note. There was a really dorky question that's one of my hobby horses. What is the difference between the effective date and the relevant date, and when does this actually matter? That's a good question because the legislation doesn't make it clear. And the answer I'm going to give you is my opinion on how the legislation actually works here. It's not the exact letter of the drafting, but I think this is the cumulative effect of the drafting. Every transaction only has one effective date and can only have one effective date. And that is the date when the transaction itself actually happens. Now, you might be thinking, what about substantial performance? Surely if I substantially perform a transaction on day 1, and then I complete it on day 5, I've got 2 effective dates for that one transaction. And the answer is no, you don't. Technically, what you have is 2 transactions because the legislation deems substantial performance to be a transaction in and of itself, and completion as a separate transaction, each of which has 1 effective date. This is why sometimes when you're looking to grandfather things, you say if it's substantially performed before a certain date, you will accept that completion after the date of the relative statutory change doesn't have any impact. Anyway, 1 transaction, 1 effective date, that's all it ever gets. And that's either, if it's substantial performance, the date of substantial performance, or it is completion. It never changes. And the most important thing that an effective date does is it locks in the rates and bands of tax as at that date. Those are the rates and bands of tax you always, always, always apply to that transaction. The relevant date, by contrast, is something that a single transaction can have many of. And the relevant date is the date, any date on which you are required to submit a tax return for that transaction. The example of when this matters most is leases, because leases, when they are granted, have an effective date. Usually they are reportable, but not always at that date. And so that is a relevant date as well. But every 3 years, you have to submit a new tax return for that lease, recalculating the LBTT. And each time you have to do that, that is a new relevant date, same as when you assign the lease or when you terminate it. But at each of those relevant dates, you still use the rates and bands in force at the effective date when the transaction actually took place. Okay, that is us to time. So if you want to ask any follow-up questions, please do feel free to email myself or Scott at the email addresses here. Okay, I hope this has been useful, and thank you to everyone who either sent in a question in advance or did so in the chat box today. Thanks all. Bye.